Welcome everyone. Thank you for joining me for the Dallas Community Tax Center's 2024 tax year tax season training for our volunteers. This year, you're going to be getting the training hot off the press. This training platform or format is new for the 2024 tax filing season. The first part of the training was an on-demand training, and we called it fundamental training. It was developed based upon feedback from previous volunteer training events. The fundamentals on demand was to introduce you to the steps in the new platform as well as get you into Vital Central to complete your ethics or your standards of conduct and your intake, interview, and quality review certifications, and to familiarize you with the tax terminology along with some pictures of acceptable taxpayer identifications, forms, and income source documents. At this point, we hope that the first two certifications have already been completed and passed because we're going to be moving. So buckle up. In this one-day training session, we'll be further expanding upon a few of the topics as well as getting you into the software uh, practice lab. Our software is called Tax Slayer. To at least begin on your advanced certification, which is your last certification, which would qualify you to help taxpayers out by preparing their tax returns free of charge. This is going to be sort of our agenda. So for items 1 and 2, we will be recapping and clarifying, if needed, some topics covered in the Fundamentals on Demand course, which should have already been taken before coming to this class. We will be moving at a pretty good clip because you've already seen and experienced some of this stuff already. We will not be doing any in-depth instructing because the basics have already been covered in the Fundamentals on Demand. We keep repeating the Fundamentals on Demand as it is critical training to have been taken before this training. This one-day training will not allow us to teach fundamentals, which you should have already taken at your own pace and accomplish all the things we need to provide you with at this time. Number 3, we'll be expanding upon some topics such as income items, some adjustments and deductions, marketplace insurance, earned income credit, that is the EIC, direct deposit refund, as well as balance due information. We hope to get in quite a bit of practice in the software via the software's practice lab. Taxpayer privacy is big and it's important. Let's just say something about it right now. The taxpayer's business, tax or otherwise, is the taxpayer's business. Anything the taxpayer discusses or shares with you remains private or confidential, meaning the entire room does not need to know the taxpayer's business, such as the amount of the refund, how much the balance due is, the taxpayer's social security numbers, direct deposit information, or any of that. If you have a question and you require clarification for yourself or the taxpayer, simply raise your hand or excuse yourself to walk over to one of us or even another experienced tax preparer. That could be your site manager, your assistant site manager. Any of us should be able to assist you with what you're having issues with. Remember, the taxpayer's business is private. This was covered in your certification, in your ethics or code of conduct lesson. If all goes well, hopefully, we can get you into the advanced certification testing to begin your final graded test. Like the other clarifications or certifications, you will need to pass with an 80% or better. So let's start with agenda item number 1, recap. So our first agenda item, fundamentals recap, we're going to be talking about who must file the Form 13614C requirements, and filing status. So our first lesson in Fundamentals on Demand, we learned that not all taxpayers are required to file. A taxpayer does not have a filing requirement if he or she doesn't have any income. Duh. Taxpayers may not be required to file if the income isn't large enough based upon the filing status and the age or ages of the taxpayers. However, the tax preparer or even the intake specialist will be able to tell almost immediately whether or not the taxpayer has a filing requirement and needs to file a federal income tax return. We will need to interview the taxpayer to make certain of that determination. Some questions right off the bat might be, are you married or single? If married, are you and your spouse filing jointly? Take a peek at the picture ID to determine age, or simply ask the taxpayer if you are under or over age 65. Or, may I take a look at your income documents to help determine what the gross income might be? Or, ask the taxpayer if they filed with us, Dallas Community Tax Centers, last year. Did they bring in last year's tax return? And then determine if anything has changed since that time. All represent interviewing skills. The taxpayer may need to file based upon the three requirements, or they may just be checking in with us to make sure one way or the other. However, if the taxpayer had marketplace health insurance during the year, they are required to file no matter what for reconciliation purposes. And we'll talk about marketplace health insurance later. Once it's been determined that the taxpayer is required to file, they will need to complete the Form 13614C. That is your intake, interview, and quality review form. As the 13614C indicates, the taxpayer will need to have all the required documentation, that is pictured ID, source documents, social security cards of everyone that's being included on the tax return, etc. All things are shown in publication 4012 tab B. You have already been certified in the intake, interview, and quality review area from the Fundamentals on Demand, so we won't spend a whole lot of time here. Another Fundamental on Demand spoke to the taxpayer's filing status. These are located on the Form 13614C in bold black lettering. They are single. That means never married or not married as of December the 31st, 2024. VITA will prepare those tax returns. There's a married filing jointly. VITA will prepare those. However, there are other questions on the married line which need to be responded to because it could qualify or lead to a more beneficial filing status for the taxpayer on the tax return, such as head of household or a qualifying surviving spouse. We can always look to the decision tree in publication 4012, tab B, page 13. Could look there even for our divorced taxpayers as well. Use the decision tree to assist in arriving at the correct filing status. One other bolded status on the 13614C is married filing separately. Dallas Community Tax Center, VITA, will not prepare tax returns for those taxpayers as they become very, very complicated, and Texas is a community property state. Okay, are there any questions before we move on to the next set of recap expectations or explanations? So we're back for agenda item number 2, fundamentals recap. In this one, we will be talking about dependents, the two types of dependents, as well as income. We know that all income is taxable unless expressly exempt from the law. So there are two types of dependents. We have qualifying child or qualifying relative. Each one of those has a specific or have specific tests which must be met. We'll take a quick peek at the 4012 tab C, page C dash the upcoming slides. Remember, you cannot claim a person as a dependent unless that person is a United States citizen, a United States resident alien, that is a dependent that has a green card or a resident alien card, a United States national, that is a person that is not a citizen but owes their allegiance to the U.S. and can travel or work without any restrictions, or is a resident of Canada or Mexico. The upcoming chart shows the test for both the qualifying dependent and the qualifying relative. Then we'll chat a little bit about the income, which is located in the 4012 publication beginning on page D-3. We know that all income is taxable, and we have many that are, but then we also have some income that is not taxable. The income, if the income is taxable, it can be input into the income section in the TaxSlayer software. The software will have a line for the specific income or a type of catch-all income line where you can input the income type as well as the amount of the income. Just note that there is always space to input taxable income. On page D-4 of the 4012, we do reference some non-taxable income, meaning that should not be included on the tax return. Each income source document has its own specific form name and number. Read the source document to determine where to correctly input the amounts in the income section. In the software. Reading the document will greatly increase your odds in successfully passing the advanced testing certification and correctly inputting the information for real live taxpayers. TaxSlayer screen will follow shortly. This slide represents the qualifying dependents tests which must be met. The test for the qualifying child, and then the test for the qualifying relative. We only have two types of dependents. For the qualifying child, the child must be your child, stepchild, foster child, sibling, half sibling, step sibling, or descendant of any of them. An adopted child is always treated as your own child. The term adopted child includes the child who was lawfully placed with you for legal adoption. Number two, the child must be under age 19 at the end of the year and younger than you or your spouse if you're filing jointly. B, under age 24 at the end of the year, a full-time student and younger than you or your spouse if you're filing jointly, or they can be any age if they're permanently and totally disabled. The child must live with you for more than half the year. That excludes temporary absences from the home to stay on university campuses. The child must not provide more than half of his or her own support for the year. Now, if the child is filing a joint return for the year with their spouse, they must be getting back all of their income tax in refund. That is income tax that's been withheld in total refund back to them. If the child meets the rules to be a qualifying child of more than one person, you must be the person entitled to claim the child as the qualifying child. So those are the tests to be a qualifying child. The test to be a qualifying relative, the person cannot be your qualifying child or are the qualifying child of any other taxpayer. A child isn't the qualifying child of any other taxpayer if the child's parents or any other person for whom the child is defined as a qualifying child isn't required to file an income tax return or files a return only to get back the refund of the income tax that's already been withheld. The person must A, be related to you in one of the ways listed under the relatives who don't live with you. You have to see Table 2, Step 2. That is right behind, I believe that's going to be on C-4. Or they must live with you all year as a member of your household, and your relationship must not violate local law. Number 3, the person's gross income for the year must be less than $5,050. And gross income includes all of those things that we see below that. In the form of money, that's goods, property, and services that isn't exempt from tax. Tells us don't include Social Security benefits unless the person is married, filing a separate return. So that is not us, so we won't even go there. And you must be the one that is furnishing over half of the person's total support for the year. Once again, remember, we cannot claim a person as a dependent unless that person is a United States citizen, a resident alien, a United States national, or a resident of Canada or Mexico. This is our input screen for inputting our income items. As you can see, this is our tax layer screen. We have a space to put our W-2 income. We have a space to put our 1099-G income, 1099-R income, that is retirement income, our pension income, annuity income. 1099-G represents unemployment compensation, or 1099 miscellaneous or 1099 NEC, that is our non-employee compensation form. All of those things can be input into the income screen inside of tax layer. You will see down here we also have a space for alimony received income. We have a space for other income. So we drop all of those that are not listed here. We can go to the other income tab. There are some others that are listed there, and we'll be able to put in the income correctly. These are just some pictures of our source documents. When I say source documents, you will look at your form 13614C in that middle part under income on page 2, under income of the 13614C, that is the intake form. You will have listed on the left-hand side all or most of the income items. On the right-hand side says to be completed by certified volunteer, income to be included. You can make notes there. It also provides you with the source document that you're looking for. For instance, if the taxpayer had checked wages as a part-time or full-time employee and how many jobs, then your source document that you're going to be looking for is going to be this W-2 right here. This is our W-2. Here's our wages in box 1. Here's our federal income tax withheld. That's what's withheld from your check for income taxes. We have a box or 2 or 3 that references Social Security, Medicare, tips, etc., etc. Then we have this box, which means something. If there's something in the box, then what we are trying to do is to mirror this source document inside of the tax layer income input screen. And we want to mirror it exactly as this says. You will see here, this is our employee's Social Security number. That is the 3 digits, 2 digits, and then the 4 digits. But then we also have something here that references the employer's identification number. That is a 9 digit number as well. However, the format is 2 digits, dash, and then 7 digits after that. We have the employer's name and address that's here, and then the employee's name and address. We have the boxes over here in boxes 12. You may have some codes that will be on the W-2 statement. You will, when you get to that screen, you will simply use the drop-down menu to find the codes to input or to mirror this information into TaxSlayer. So everything in here is very important for us to prepare the accurate and correct return for our taxpayers. Now, you will also notice down here, this is a W-2G, and it resembles our W-2, right? Most of our source documents look almost exactly alike. However, it's incumbent upon us to read the form. This one, 1099-G, happens to be the unemployment compensation form. This is how much unemployment taxpayer has received. Um, this is the federal income tax that's been withheld. I keep referencing that because the federal income tax withheld helps to pay the federal income tax. Okay? So that is in box 4. Most of these others we will not be dealing with. However, on the left-hand side, we can see the payer that paid the unemployment to the taxpayer. Then you'll see payer's tax identification number. That's kind of the same thing as the employer's identification number. That is 2 digits, dash, and then 7 digits afterwards. The recipient's tax identification number is going to be typically the employee's Social Security number or the Social Security number of the taxpayer. So be cognizant of that. Let's just show you just a few more of these. This happens to be the 1099 NEC, non-employee compensation form. Um, Looks almost exactly like any other source document, the W-2, the 1099. So just know that we have to read what the form is as well as the form number down here. This form, 1099 NEC, also has a federal income tax withheld box. So if there's been any income tax withheld, it will go here. Once again, we are mirroring the paper source document into the TaxSlayer. Another one is going to be our 1099 INT, which is our interest income form. We will receive this from our maybe our credit unions, our banks, our could be from any place that pays interest income, any of our investment spots that pay some interest income. Once again, this is going to be our interest income right here. Typically, this will have a calendar year that's listed here. Uh, Early withdrawal penalty. So we'll circle back around to this because this means something a little bit further down the line. That is the early withdrawal penalty. This is income when the taxpayer has cashed in some savings bonds. The taxpayer will get a statement like this, uh, uh, indicating how much interest those bonds, those cash bonds had on them. Then box 4 again is your federal income tax withheld. Once again, you will notice the payer's name, the payer's tax identification number, the recipient's tax identification number, that is Social Security number, recipient's address, um, foreign tax paid, that could mean something a little bit further down the line. So we'll touch upon that as we move further in. One or two more. This happens to be our retirement, our pensions, annuities, retirement, or other profit sharing plan, distributions from any type of retirement plan. You will have a figure in box 1, which was the total distribution. Then there should be a taxable amount of that distribution if there's something there. If it's nothing there, inside of the software, we will leave it blank, or if it pops in and nothing is shown on the source document in this box, you can just not zero it out, but make that blank. Just take it out altogether. But we'll be there to help you with that. Once again, you have your federal income tax withheld box. We have down here our specific distribution codes, whether it was from an IRA or other retirement plan. The payer's name, payer's tax identification number, recipient's identification number, or social security number, recipient's address, and so on and so forth. This would be the total employee contributions. How much did the employee pay into that plan? That will be there. So that will come into play when we start the input for this particular form. That is your 1099-R. Then we have a 1099-DIV, which is our dividend distribution, dividends and distributions form. All of these boxes have specific input lines in the software. So we got to be sure that we're picking up all of those little boxes. Once again, there's a foreign tax paid. That's there. So as I said earlier, that will come into play just a little bit later. So just hang tight. And then we have our final form that we're going to talk about, I believe, is the form SSA 1099, which is our Social Security benefit statement form. If the taxpayer comes in and they say, we ask them, is this all of your income? Is this all that you receive? They may say, no, I received Social Security benefits during the year. Then the taxpayer needs to produce this form, SSA 1099, Social Security benefit statement. This form, you will recognize it because it's typically pink and black with a white background. It's a long form. So the taxpayer will remember the form. They don't always bring it, but if they don't bring it, they will need to return home, go and get it, or if somebody is at home, if they can take a picture of it and send it over to the taxpayer's phone, we can take a look at it and be able to uh, uh, put the information inside of TaxLayer. But if they receive Social Security benefits, yes, we need to put it on the tax return. Social Security benefits by itself alone, no other income, is not taxable. However, if the taxpayer receives, in addition to Social Security benefits, wages, pensions, all of those things, if they receive any other type of income, then yes, the Social Security will need to be shown on the taxpayer's return. It may or may not be taxable. It may be, some of it may be taxable. Uh, Most of it may be taxable. We don't know. It just adds to the rest of the income inside TaxSlayer. For agenda item number 3, we're going to be talking about adjustments and deductions. Those are located on Form 1040, which is the income tax return, on page 1. Just know that adjustments and deductions both are used to reduce the income on the tax return or on page 1 of the 1040. Now, this slide represents what our adjustment screen looks like in our tax layer input screen. So we'll talk about adjustments first, and then we'll talk about deductions. So some of the adjustments that we'll be talking about are arrowed. One is the educator expenses that is available for our educators. Also, the health savings account, that is the HSA. We'll talk a little bit about the self-employed health insurance coverage. Is a penalty on early withdrawal of savings or certificate of deposit. I think I mentioned this on the when we were talking about the income 1099 interest form. There is a box that spoke to early withdrawal penalty. So that's what that's talking about. Then we have the alimony paid. That can be an adjustment to income. Our traditional IRA contributions, which is an adjustment to income, student loan interest, as well as some other adjustments here. So we'll take each one individually. The first one is our educator expenses. This is a screenshot of what is in publication 4012, page E dash 8. It references what the maximum benefit is, which is $300 per educator. If both of them are educators, they can deduct up to $600 as an adjustment to their tax return if they're married filing jointly. Who can claim the expense? That is going to be our eligible educators. And eligible educator is a kindergarten through grade 12 teacher, instructor, counselor, principal, or aide who worked in the school for at least $900 during the school year. What are some qualifying expenses? Uh, Ordinary and necessary expenses paid in connection with books, supplies, equipment, etc. Other qualified expenses can include protective equipment, disinfectant, and other supplies used for the prevention of the spread of a virus. So, what are non-qualifying expenses? Expenses for homeschooling or non-athletic supplies for courses in health and physical education. So, those are things that don't qualify. On the 13614C, the intake form, right on that very first page, if we walk across from the taxpayer's name, first name, middle initial, last name, date of birth, that next little box on that same line is your job title. Most of our educators, they'll let you know straight up front, that I'm a teacher, and yes, I spent more than $300 in educator expenses. So we're not asking them for receipts or anything. We're taking their word for it. And that limit is $300 per educator. Another adjustment is our health savings account. This is a health insurance account or a savings account. So to determine the health savings eligibility to set up a health savings account and make contributions to an HSA, to qualify, the individual must meet all of the following requirements. They must be covered under a high deductible health plan on the first day of any month of the year. They must not have any other health insurance coverage except for allowable other health coverage. Uh, that is delineated in the publication 469. They must not be claimed as a dependent on someone else's tax return, and they must not be covered by Medicare. But the individual can have HSA eligibility for the months before being covered by Medicare. So we're taking the months when they were not covered by any other health insurance plan. Now, our part one, HSA contributions and deductions, if eligible, were contributions made to an HSA? So we have to answer that question. And if the taxpayer is a candidate for this health savings account, we will input the information from actually two different forms. There is a contribution form that the taxpayer should bring in with them, as well as a distribution form if there were any distributions made for the year. So how would I know if a taxpayer has an HSA account? If I were to go to my yellow form, the 13614C, the intake sheet, and go down to page 3, that last segment, did any of the following happen during 2024? That uh, third bullet down references health savings account. So if the taxpayer has checked that, then we walk over to the shaded area or the grayed out area. Were they contributions, distributions, or what? So we'll have to make a check mark there. All right. So then this happens to be our contribution form. Looks like same old source documents. It has HSA up here, total contributions in 2024. This box, HSA, must be checked, and the form number is Form 5498. This comes from the health insurance, whoever is administering this HSA account for the taxpayer. So all of this needs to be included. By the way, when the taxpayer gets their copy of a source document, just know that whomever provided that source document to the taxpayer, they are also sending that a copy of that source document to the IRS, so that at some point in time, the IRS goes back to reconcile all of these source documents together to make sure that everything has been included on the return. So this is our contribution form. This happens to be our distribution form from the HSA. This is Form 1099-SA. This is distributions once again. Once again, that little box right there is checked. This is the trustee. I guess that's the trustee that administers the plan, the HSA savings account. This is the trustees or payer's name, payer's tax identification number, the same thing we've been looking at on the other source documents. So all of that needs to be information needs to be completed, and the taxpayer would need to bring in both of those. Just know when the distributions are made, my question would be to the taxpayer, what did you use the distribution for? If the taxpayer tells me something other than I use the distribution to help pay for my medical expenses, if anything else the taxpayer gives me, then the taxpayer is going to be penalized for not using that distribution to pay those medical expenses. Okay? Because that's what the HSA account is all about. I'm saving up to pay for this medical bill that I've got coming down the line uh, in the future. So the taxpayer, and it's a pretty hefty penalty. The penalty is 20% of that distribution that was not used for medical expenses. And it gets added to the income tax. And we'll talk about that further as we move on. That's on the back page of the Form 1040. All right. Then we have another adjustment to income, which is the individual retirement account contributions. IRA contribution information. This is our IRA contributions in box 1. Any rollovers, then our little box down here is checked. And any other thing that needs to be included in the TaxSlayer software. So if these boxes are not there, we're not going to worry about them. Just take that source document, input that source document to mirror that source document into the software. The IRA for 2024 is $7,000. Just looking here, it is $7,000 per individual contribution. For 2024, the total contributions you can make to all of your traditional IRAs and Roth IRAs can't be any more than $7,000. It can be up to $8,000 if you're over age, or if you're age 50 or older, or if your taxable compensation for the year is less, then the taxpayer is limited to that lesser amount. TaxSlayer will take all those things under consideration. Um, so we can mirror what this source document says inside of TaxSlayer. If there's an adjustment that needs to be made, TaxSlayer will take care of that as well. Then we have our student loan interest adjustment. This is located in our publication 4012, once again, page E-17. So our maximum amount that we can adjust for student loan interest is $2,500. If the taxpayer is trying to get that student loan paid off and the interest adds up to more than $2,500, the taxpayer is limited to that $2,500 as an adjustment to income. The rest of it is lost for the year. Qualifications: the taxpayer must be legally liable for the loan, must have been taken out solely to pay for educational expenses, and can't be from a related person or made under a qualified employer plan. The student must be the taxpayer, the spouse, or a person who was the taxpayer's dependent when the loan was taken out, or could have been a dependent, except that dependent would have filed a joint return with their spouse and gotten back all of their refund. The student must have been enrolled at least half-time in a program leading to a degree, a certificate, or other recognized educational credential. Taxpayer can deduct interest paid during the remaining period of the student loan. So those folks that are out of school and have been out of college for a while are still paying on their student loan. They're still able to take that student loan interest adjustment or on their tax return up to a maximum of $2,500. Okay. This is the form that the taxpayer will receive regarding student loan interest. Once again, it looks like the other source documents. This form happens to be the 1098E. Your form number: student loan interest received by the lender is going to go in box 1. See what this is. This is normally not in anything, and this is all information for us to input into TaxSlayer. And the taxpayer will keep this as a copy. Nothing goes in with the tax return. And it does say keep for your records. Okay, so that was the adjustments part. Remember, adjustments and deductions are used to reduce the income down so that we're paying a less tax on the income. So after the adjustments, we're going to talk about our standard deductions now. Our standard deductions is something that's already been delineated into law for us, a set amount based upon our filing status. So we have 3 different charts that are shown here on this particular slide. This chart provides the standard deduction amounts for tax year 2024. Standard deduction for most people. If the taxpayer's filing status is single or married filing separately, their standard deduction is $14,600. If they're filing joint or as a qualifying surviving spouse, their standard deduction is $2,920. Head of household, it's going to be $21,900. And then my little highlighted area here, don't use this chart if the taxpayer was born before January the 2nd, 1960, or is blind, or if someone can claim the taxpayer as a dependent or their spouse if they're married filing jointly, then we go to another little chart. So this is the standard chart for most people. For those people that were born before January the 2nd, 1960, or who is blind, this is the chart that we're going to be using. So first off, we have to figure out what is the age of the taxpayer? Were you born before January 2nd, 1960? We could put a little check box right there. Let's just say we're single. Put a little check mark right there. And I'm also blind. Put a little check right there for you are blind. So if I total up those two checks, then I'm going to have a 2 in this box. If my filing status is single, which is I am by the example I just gave, and I have, and the number in the box above is 2, which it is because I was born before January 2nd, 1960, and I am also blind. That would be 2. My standard deduction is now 18,500 instead of this 14,600 here. Same thing for married filing jointly, and so on and so forth. This just happens to be a half chart, but we can look at the full chart that is on page F or tab F, page 3 through 5. So you can see how that pops up. The standard deduction gets a little bit bigger based upon my situation, whether I'm old, oh, I shouldn't say old, whether or not I was born before January 2nd, 1960, and was also blind. So we would use this chart. Now, here's another little chart or a worksheet for our dependents. It tells us to use this worksheet only if someone else can claim you or your spouse as a dependent. So we walk through that and work through all of that if we wanted to. However, based upon some information that we've already input into TaxSlayer is going to automatically figure the standard deduction, the blindness situation, the age situation, as well as the dependent situation. TaxSlayer, we have enough information in TaxSlayer already for TaxSlayer to figure all this out for us. All right? Now, we can take the standard deduction, as we just talked about, or we can elect to itemize our deductions. Now, our itemized deductions are going to include things such as medical and dental expenses, taxes you paid on your state and local taxes, taxes you paid on your real estate, your mortgage, personal property taxes, etc. This is not your registration, car registration does not include here. Interest you paid on your home or any of your personal property would go in here. Charity, gifts to charity, that is cash as well as non-cash. It would go in this area here. And then some other itemized deductions such as your professional fees, etc., etc. Now, if this itemized deduction exceeds the standard deduction amount, then we will itemize. Our TaxSlayer would allow us to itemize. TaxSlayer is going to give you the best benefit. Now, if the taxpayer decides, oh no, I still want to itemize, I know that my standard deduction is higher, but I still want to itemize, there's a little box that we're going to check inside of TaxSlayer and tell TaxSlayer to use the standard deduction amount. Why? I don't know. We haven't used standard deduction in a while because, I'm sorry, we haven't used itemized deductions in a while because our standard deduction keeps going up and up and up every year. So that we don't have to keep up with all the little receipts and you know, keep account of all the things. We'll still pay our taxes, our real estate taxes, et cetera, but we don't have to keep up with that stuff anymore. And I am just good with that. Okay, so now we've talked about the standard deduction as well as the itemized deduction. So we can take either one of those and the qualified business income deduction. Now, as the name indicates, the qualified uh, deduction is a business deduction and it is used to reduce the income. The QBI deduction is the lesser of 20% of the qualified business income or 25% of taxable income. This is an automatic calculation as well. If the taxpayer is in business uh, for themselves, we've already calculated the income and the expenses. Let me say that TaxSlayer has already calculated the income as well as the expenses based upon the information that we've input there. And so TaxSlayer will now go ahead and calculate that QBI deduction to reduce the income. So I put in a little haha right here. If the taxable income before the QBI deduction exceeds $383,900 for marriage filing joint, et cetera, et cetera, et cetera. This is not going to be our taxpayer. Our top at our sites for VITA is about $67,000. So just keep that in mind. But uh, still, TaxSlayer will figure the QBI for us. All right. So this is information from the publication 4012, once again, tab B3. This is our entity information. This is really what the actual tax return looks like for 2024. Here's our entity information. Here is our Social Security numbers that we have input correctly. Here's our presidential election campaign. Whether or not the taxpayer wanted to make a contribution. If on the if on the 13614C, that's where this information is. If the taxpayer does not answer that or does not check that, my assumption is that they have read it, they understood it, and they do not want to make a contribution. I am not going to press them about it in terms of, hey, you didn't answer this. Well, okay, they saw it, so they don't want to answer it. All right, so we're good with that. So we'll move on from there. Also, we have our filing status here. Anything to do with this area up here, we can always go to tab B to find the answer or get some direction. And all of these tabs are referencing where we can go to find an answer. This is for our dependents. This is our income section. So if you look right down here, we have arrived at, on line 9, we have arrived at the total income. This is all of our income, our wages, our tips, our uh, other earned income. This could be our business income, our interest, our dividends, our distributions, pensions, Social Security. All of that is already calculated above line 9 to arrive at total income. Then we have our adjustments that we just spoke to, our student loan interest, our HSA, health savings account, our um, other things that we have talked about, our IRA adjustments, and so on and so forth. So all of those come into play on line 10. Line 11 now, we're at our adjusted gross income or our AGI. Line 12 is our standard deduction or our itemized deductions, which over here in the little bubble is the figures from the chart, that first chart where the ages and the blindness is not recognized over here in this chart. But TaxSlayer will take care of that and drop the correct standard deduction or the itemized deduction to line 12. Line 13 is our QBI, our business income deduction. Those two are added together to drop to line 14. Then line 14 gets subtracted from line 11, or adjusted gross income. So now we are down to our taxable income. This figure on line 15 is where we will pay our taxes at. Now we'll be moving on to agenda item number 4, where we'll talk about our other taxes. Okay, so we left off with line 15 on the face of the Form 1040. This is the back, page 2 of the 1040. This is our federal income tax right here on line 16. Okay, that's where TaxSlayer has figured our correct federal income taxes as it stands from the face of the 1040. So now we're on line 17, and line 17 references a Schedule 2, a line 3. So let's just run over and see what that is. Schedule 2 is our other taxes schedule. Okay, so our other taxes are added to line 16, our federal income taxes. The first one is our excess premium tax repayment. This has to do with the marketplace insurance. Okay? Then we have other taxes under part 2 of that same Schedule 2 form that's here. These amounts are usually calculated on their own form or schedule and entered on Form 1040 Schedule 2. The Part 2 taxes are added after the non-refundable credits are calculated. The non-refundable credits do not reduce the Part 2 taxes. That is self-employment taxes, Social Security taxes on tips, additional tax for early distribution, as well as the first-time home buyers credit. So we'll talk about these individually, but for right now, let's just concentrate on line 17, which encompasses the premium tax credit repayment, part 1. So this is Schedule 2, additional taxes, Schedule 2. This is our additional taxes. This right here is the excess advanced premium tax credit, Form 8962. Once again, this means that the taxpayer was involved in marketplace health insurance arena. Taxpayer could have enrolled themselves for the health insurance, or someone else could have enrolled them, or even another entity could have enrolled them automatically based upon some other existing circumstances. The marketplace health insurance provides the taxpayer with the Form 1095A showing the recipient's information, the covered individuals on the health plan, as well as the coverage amounts. If the taxpayer responds with a check mark on the 13614C, page 3, let me just pull this out here. This is my page 3, and we are that last big item, big section on page 3. Did any of the following happen in or during 2024? Drop down to that third bullet. Did you purchase health insurance through the marketplace? Then over in the shaded or the grayed area, it tells us we need the Form 1095A. If this happened The taxpayer should also have in their possession the Form 1095-A from the marketplace or the exchange health insurance. TaxSlayer software then asks a series of questions uh, before the tax a series of questions before the tax preparer begins to mirror the 1095-A into the software. So, what does Marketplace Exchange Health Insurance do? I'm glad you asked. Marketplace health insurance, also referred to as Obamacare, subsidizes or helps the taxpayer pay or maintain health insurance coverage based upon what the marketplace or what the taxpayer told the marketplace representative when they called to request health insurance for themselves or others on their tax return. These subsidies are called advance premium tax credit payments. At the end of the year, the marketplace issues the Form 1095-A based upon those initial or subsequent conversations with the taxpayer. Now, after responding to a series of questions in the software, the taxpayer's job, or the tax preparer's job, once again, is to mirror the paper document, the Form 1095-A, into the software. After mirroring the information in TaxSlayer, the Form 8962 is generated. The Form 8962 bottom line will show either an excess advance premium tax uh, credit, meaning the marketplace credited too much, or excess subsidy based upon the taxpayer's current year's income status. The taxpayer's actual income for the year was more than what uh, the taxpayer initially communicated to the marketplace. At this point, the taxpayer has excess repayment or additional taxes to pay in addition to the regular income taxes. The marketplace subsidy amount could have been too small or too little based upon the taxpayer's current income status, resulting in a refundable net premium tax credit payment to the taxpayer, which adds to the refund amount. Or the marketplace subsidy could have gotten it just right. They were right on point so that there's no excess uh, repayment that has to be repaid, or there's no refund that's due the taxpayer. At any rate, we are mirroring the 1095-A information correctly into the software, which generates the Form 8962 automatically, whether there's an excess credit repayment or a refund payment due to the taxpayer, or it's all even. The software automatically calculates all of this for us. Taxpayer needs to have this Form 1095-A if they had health insurance. Sometimes the taxpayer can get on the phone with the marketplace and we will have blank Form 1095-As there on site with us. The taxpayer can leave not leave the site, but leave the room that we are in, go out and call the marketplace, provide the marketplace with whatever identifying information that they need, and that they can give the taxpayer the information over the phone. Taxpayer can write that down on the Form 1095-A. We can use that to input the information into the software. But all of the information needs to be completed on the Form 1095-A. Okay, let's see. So this is our schedule. This is the Form 1095-A that they'll get from the marketplace. So you can see all the recipients' information is going to be here. The covered individuals are going to be here. And then these boxes or columns will be filled in as well for the months that the taxpayer had marketplace health insurance coverage. We're just mirroring this information into TaxSlayer. Once we mirror the information into TaxSlayer, this form 8962, which is the premium tax credit form, will generate by that input. So these are the columns that showed up on the form 1095A. It's column A, column B, and this is the column C. So you can see this is going to come from the 1095A, column A. This is going to come from the form 1095A, column B, and this column represents column C from the 1095A. All of this is automatically calculated. My arrow here indicates line 626, which is the net premium tax credit. This happens to be the refund. This is going to go on Schedule 3, but we're talking about Schedule 2. This is the excess premium tax credit repayment. So this will go on Schedule 2. If there's a figure here, it will generate automatically over to Schedule 2, line 1A, which we showed you earlier. So now we're at agenda item number 5. Once again, we're on the Form 1040, page 2. We're going to talk about some available credits. Refundable, which is money in the pocket type of credit, and then the non-refundable, which can only be used to reduce your tax liability down to 0. So our non-refundable credits, a non-refundable credit is a dollar for dollar reduction of the tax liability. A non-refundable credit can only reduce the tax liability to 0. For an example, the taxpayer has a tax liability of $1,000 and non-refundable credit of $1,200. The tax liability then becomes a 0 and the remaining $200 is lost. So a non-refundable credit is more than the tax liability. We're limited to the tax liability. Here's our Schedule 3, which is another schedule that attaches to the 1040. These are our additional credits and payment section. Section 1 right here deals with the non-refundable credits. They are the foreign tax credit. We saw that on some forms, 1099, DIV, and income statement form. Here's another credit, the credit for child and dependent care expenses. That's going to generate drop down to the form 2441. We have education credits, which is the form 8863. We have 2 of them. We'll talk about those in a minute. We have the retirement savings contribution credit that is available as a non-refundable credit. Then we have an energy efficient home improvement credit that is a non-refundable credit, has to do with energy efficient home improvements. We have a credit for the elderly or disabled. We don't see that too much anymore. And then all of these non-refundable credits right here will drop down to line 8. And it will enter here and on the 1040 line 20. So I'll show you that in a minute. But in addition to part 1 non-refundable credits, there is a part 2 that speaks to other payments and refundable credits. We just got done talking about the net premium tax credit from the marketplace insurance situation, where the marketplace did not pay enough subsidy to the taxpayer based upon the taxpayer's current uh, income. So they are receiving a credit amount, and it drops into the payment section because that becomes a refundable credit to them. So that is Schedule 3. So let's see if we can walk through this. Our non-refundable credits for our foreign taxes. United States citizens and residents compute their United States taxes based upon their worldwide income. Taxpayers who pay taxes to a foreign country or United States possession may be entitled to a non-refundable credit on their United States taxes. Taxpayers who receive the form, these are your income forms, 1099 INT or the form 1099 DIV or a K1 may have amounts indicating that foreign taxes have been paid on their behalf by the issuer of the document. It's a little note, foreign tax credits were taken care of on the form 1099 INT and DIV were entered during the income section. If we had foreign credit amounts shown on either of their forms, then it's going to drop over here to Schedule 3, Part 1, inside line 1. Another non-refundable credit is our child and dependent care expenses. This is a non-refundable credit available to taxpayers who pay someone to take care of their qualifying person in order for them to work or to look for work. Publication 4012, tab G, pages 12 and 13, gives us this information, a screening sheet for our child and dependent care expenses. To determine if a taxpayer qualifies for either or both of the child and dependent the credit for child and dependent care expenses, or even exclusion of income from dependent care benefits. That will show up on the Form W-2 with the code in box 10. But who are qualifying persons? A qualifying person is a child who was under age 13 when the expenses were incurred and who can be claimed as a dependent on the taxpayer's tax return. So it's got to be under age 13. Those months that the child is under age 13 and had these type of expenses, child independent care expenses, we can take that expense for those months when the child was under age 13. Number 2, any person who was incapable of self-care, whom the taxpayer can claim as a dependent or could have been claimed as a dependent, except that that person had gross income of more than $5,050 or filed a joint return, or that the taxpayer or spouse, if filing jointly, could be claimed as a dependent on someone else's tax return. So this specifically is dealing with a person who was incapable of self-care. And then we have a definition. What does it mean when we say incapable of self-care? Or it could be a spouse who was physically or mentally incapable of self-care. The qualifying person must live with the taxpayer over half of the year. Some of those qualified work-related expenses, the expenses must be paid for the care of the qualifying person to allow the taxpayer or the spouse, if married, to work or to look for work. The care includes the cost of services for the qualifying person's well-being and protection. Expenses to attend a kindergarten or a higher grade aren't an expense for this care. Expenses for before and after school care can qualify. Summer camp, summer day camp are also qualifying, but not overnight camp. Okay? So all of this is delineated on tab G, page 12 and 13. Once again, these are the requirements here. So we've already talked about who the qualifying person is, earned income test. They must be working, must be work-related expense or care of the qualifying person. Uh, the company or the person that is providing the care must also have a identification number and telephone number and must furnish the taxpayer with a statement regarding the amount of the expense. The credit ranges from 35 to 50% of the taxpayer's expense, so just know that. See, the credit is limited to $3,000 for one qualifying person or $6,000 for two or more qualifying persons. Once again, this information is in your tab G-14. Once we input all of the information as it should be, then TaxSlayer will take care of the majority of that. This is a non-refundable credit which only reduces the tax liability down to zero. This happens to be the input screen inside of TaxSlayer for entering child and dependent care expenses. So you can see here's our child care provider information, the provider's ID number, the provider's name, the country, the address, the state, and it has to have a telephone number. The next little screen inside of TaxSlayer dealing with this, we got to know who the recipients are that this care was provided to and what the amount was. So we will have our dependents here and we can check who these expenses were for. Ultimately, the information will end up on the form 2441, which is our child independent care expense form. All of this information would have already been completed for us here. These are our percentages that's here, just as an FYI to the taxpayer. And then this has to do with dependent care benefits. I'm not sure if I've even seen this before, but it's available and it's a part of the dependent care expense. Another non-refundable credit is the retirement savings contribution credit. Retirement savings contribution credit, once again, is a non-refundable credit available to eligible taxpayers to claim if they made a qualifying contribution to a retirement plan. If the contribution is a tax-deductible contribution, such as an IRA, as an adjustment to income, the taxpayer receives a benefit of the tax adjustment on the face of the Form 1040, as well as a tax credit on the back of the Form 1040. This is considered a double benefit and is rarely ever allowed, but it is in this case. This contribution will show up on Schedule 3 of the Form 1040, Part 1, Line 4. This is the percentage chart based upon the filing status, and then the income is here. Once again, TaxSlayer makes those adjustments for us. We don't have to do anything. Another big one that we see from our clients, another non-refundable credit, is the child tax credit. This is a credit intended to reduce the tax. This part of the credit isn't refundable. So when they say this part of the credit, so there's got to be another part somewhere. But this part of the credit isn't refundable. The credit is up to $2,000 per qualifying child and automatically calculates for us. The qualifying child must be under age 17 at the end of the year. They must be a citizen or United States national or a resident alien of the United States. The child must be claimed as your dependent. These are definitions of your child under number 4. Number 5, the child did not provide more than half of his own support. The child lived with you for more than half the year, except for temporary absences, and the child must have a Social Security number that is valid for employment issued before the due date of the return, including extensions. Okay? Very important. The child must have a valid Social Security number for the child tax credit. Then there is another refundable, non-refundable credit that deals with other dependents. There is a $500 credit that is available for other dependents who do not qualify for the child tax credit. The dependent must be a United States citizen, a national, United States national, or a resident of the United States. The dependent must have a valid identification number. So they can have a Social Security number, they can have a individual ITIN number, tax identification number, or they can have an adoption identification number. The $500 non-refundable credit is available to dependents who don't qualify for the child tax credit, such as your child or children who are age 17 and above, or dependents with other relationships, such as your elderly parents, or for children who do not have a valid Social Security number. Taxpayers cannot claim the credit for themselves or their spouse. So here's a little $500 credit for other dependents. And that is a non-refundable credit as well. Another non-refundable credit is the credit for the elderly or the disabled. Individuals who qualify for the elderly or the disabled credit are age 65 or older, or under age 65, retired on permanent and total disability, receiving taxable disability income, and under the mandatory retirement age of the company. Once again, the taxpayer should bring you in a source document that has all of the information on it that the taxpayer is receiving disability. The little chart on page G-23 that references the elderly or the disabled. Once again, if you are, these are our filing statuses over here, then you generally can't take the credit if the adjusted gross income are these amounts, or the total of your non-taxable Social Security and other non-tax pension annuities or disability income is equal to or more than these amounts. So these are some very small amounts here. We have very few people or taxpayers or clients that would meet these qualifications here. All right, so this is our credit for our qualifying children and other dependents. This is our form 8812. This is where our child tax credit will go and our credit for other dependents would go. So it stands on its own. It's a form by itself, but it attaches to the form 1040. Now, just like we said, the child tax credit was a credit intended to reduce the tax liability. With that child tax credit, there is both a non-refundable component as well as a refundable component, which drops down to the same 88 Form 8812 and then drop down to Part 2B. Yeah, I'm sorry, Part 2C. And it tells us where that needs to be put at on the Form 1040. Okay, now we have one more credit. I believe this is the last one, the non-refundable education credit. We have two of them, the American Opportunity Credit, where 40% of the American Opportunity Credit can be used as a refundable credit. And then we have the Lifetime Learning Credit. Our education tab is tab J in our form, um, in our publication 4012. American Opportunity, the maximum credit. The maximum credit is 25, maximum credit available is 2,500. The non-refundable, 60% of that is non-refundable, and the refundable part is 40%. And that credit is available per eligible student on the tax return, which is here. Another education credit is our lifetime learning credit. The lifetime learning credit is a maximum of $2,000 per return. It is a non-refundable credit. It does not have a refundable component with it. It is limited to $2,000 per return. And then we've already talked about the student loan interest deduction that shows up on the face of the Form 1040 as an adjustment. Taxpayers can take the education credits for themselves or for their dependents claimed on the tax return who were enrolled at an eligible post-secondary educational institution during the tax year. Then it references what an eligible institution is. Again, that's tab J. Additional information that shows up on page J-9 and 10, it talks about who can claim the credit. Taxpayers who paid the education expense for a student enrolled at or attended an eligible education institution, as typically or normally our parent, or it could be the eligible student. It can be either the taxpayer's spouse, or dependents. Talks about who can claim a dependent's expense. If the taxpayer has a dependent who is an eligible student, then only the taxpayer can claim the credit based upon the dependent's expense. If the taxpayer doesn't claim the dependent on the return, then the dependent is entitled to the credit. So we can always go back to tab J for some clarification there. What expenses qualify? It gives us this information. And then what are qualifying expenses? For the American Opportunity Credit, course-related materials or books, supplies, equipments needed for a course or of study, whether or not the materials are purchased from the educational institution as a condition of enrollment. The purchase of a computer or peripheral equipment, computer software, etc., etc. All of that is a qualifying expense for the American Opportunity Credit. For the Lifetime Learning Credit, course-related books, materials, and supplies are not included as qualified expenses unless paid directly to the institution as a condition of enrollment. So you've got two different sets of requirements there. So once again, we can always go back to J-9 or 10 to figure out all of this. If the taxpayer has any questions, we'll be able to show it to him in black and white. Another comparison chart right here, that's on page J-8. I won't go back through that because it's, well, in fact, I will. So here's some credit conditions. I just want you to know about that. Once again, American Opportunity is $2,000 per eligible student. It talks about $180,000 if married filing joint. That's the limit. 40% of the credit may be refundable. The rest is non-refundable. This credit is only available if the student had not completed the first 4 years of post-secondary education before 2024. It is available only for 4 years per eligible student. The student must be pursuing a program leading to a degree or other recognized education credential. The student must be enrolled at least half-time for at least one academic period beginning during 2024. At the end of 2024, the student must not have been convicted of a felony for possessing or distributing a controlled substance. Then once again, it talks about the qualifying expenses and the payments. The students, the filers and students must all have a tax identification number by the due date of the 2024 return. And the institution must provide the educational institution's employer identification number. So all of those things are listed under the American Opportunity Credit. Then we can come over to the Lifetime Learning Credit. That credit is $2,000 or up to $2,000 credit per return. The AGI amounts are the same. It is a non-refundable credit limited to the amount of tax you pay on your taxable income. It is available for all years of post-secondary education and for courses to acquire or improve job skills. It is available for an unlimited number of years. The student need not be pursuing a program leading to a degree or other recognized educational credential. Available for one or more courses. Felony drug convictions do not make the student ineligible. Tuition and required education fees, including amounts required to be paid to the institution for course-related books, supplies, and equipment. So they must give that, purchase that from the school. And the payments made in 2024 for the academic periods beginning 2024 are the first 3 months of 2025. So here is your chart of comparisons for education expenses here. Then we have a little note down here. None of the credit is refundable if, one, the taxpayer claiming the credit is A, under age 18, or B, age 18 at the end of the year, and their earned income was less than half of their own support, or C, a full-time student over 18 and under 24, and their earned income was less than one half of their own support, and the taxpayer has at least one living parent, and the taxpayer doesn't file a joint return. So it's all kinds of stipulations and stuff regarding that refundable part of the American Opportunity Credit. So all of that information is delineated inside of TaxSlayer with questions we need to answer when we get over to the education credit section. This is our education tuition statement here. This is our Form 1098-T. Here is our university name here, the identification number, student's name, student's social security number, address, etc. Box 1, payments received for qualified tuition and related expenses. That's going to go in box 1. But you will notice here's a box 5 dealing with scholarships and grants. If the student receives scholarships and grants, and it's indicated here in box 5, the IRS looks at the scholarships and grants as having to have helped pay the tuition that is in box 1. So we will have to take, oh, now this is where we get to use our handheld calculators. We have to take box 1 and subtract the scholarships and grants to come up with a subtotal here. And then to that subtotal, we can now add our other education expenses or supplies like our laptop, like our some internet, some books, and all of those other things. Now, our room and board is not a part of the eligible education expenses, so just know that. Now, if our scholarship box happens to be more than what our tuitions received box is, that is box 1, there is a potential that the student will have some income that he needs to report. Whether or not that income would make him a required to file person just depends upon what the figure is. So here's our schedule 3 again. This is our additional credits and payments. These, once again, are our non-refundable credits. Foreign tax credit, we talked about that. Child credit for child independent care expenses, education credits, our retirement savings, our energy efficient uh, home improvement credit, and so on and so forth. So all of those, once again, are our non-refundable credits. And then our net premium tax credit becomes a payment or added to our refund there. So where are we? We started on line 16. We had to, line 17 is our repayment of our net premium tax credit from our marketplace insurance. We added those two together to come down to line 8. Then we have our child tax credit or our credit for other dependents from the form 8812, which will show up on line 19. And then we have our other non-refundable credits from schedule 3, line 8. Those two gets added together to arrive down here at line 21. Then we're able to subtract line 21 from our tax up here. Okay, so if our tax is more than our line 21, no, subtract line 21. Let me do it that way. Subtract line 21 from line 18. If the amount is 0 or less, we'll just put a 0 there because we're limited to our non-refundable credits here and the tax liability. But now if our tax liability is more than our non-refundable credits here, we still have a little bit of tax down here on line 22. But then remember, we have some other taxes that cannot take advantage of these non-refundable credits here. Remember we talked about that little box? It's going to be these Part 2 taxes, which is our self-employment tax, our Social Security tax on our tips, our additional taxes on the IRA for a premature distribution. We have our repayment of our first-time home buyers credit, and then our HSA distribution tax for not using that distribution for medical expenses. So let's talk about that. This is actually our business schedule. This is Schedule C. This is our profit and loss from our business, our profession. So this is our taxpayer information here. This is the income that the taxpayer has earned, self-employment. These are all of his expenses that he's entitled to. So somewhere down here, we'll subtract our total expenses from our total income to come up with our net profit or loss from our business, from our self-employment business. So this down here is where the self-employed person will pay his self-employment tax. So let me just say right here, our self-employment tax is the same thing as our Social Security taxes. When you're an employee, the employer withholds one half of the self-employment taxes from you, and then the other half of that self-employment tax the employer pays. But for a self-employed individual, he or she pays the entire tax amount. What is that tax amount? It is 12.4% of the profit. That is his self-employment tax. The other, I believe the 2.9% is Medicare right here. So it's a pretty big percentage that self-employment taxes is. So the self-employment taxes shows here on line 12. It tells us to enter here, and on Schedule 2, line 4 of the 1040 return. Now, because nobody is paying the self-employment tax except the self-employed individual, the IRS allows the taxpayer to deduct one half of that self-employment tax on the face of the form 1040 or Schedule 1. They're able to deduct one half of that. One half is reducing the income on the face of the 1040, but then he's paying the full tax amount on the self-employment tax schedule. That happens to be right here, the self-employment tax. Other taxes, if a distribution is taken before the taxpayer reaches, and I'm talking about a retirement IRA or qualified retirement plan distribution is taken before the taxpayer reaches age 59 and a half, and that distribution is not rolled over into another qualified plan or IRA, and no exception applies, the taxpayer is subject to 10% of that distribution that gets added to the tax return in the form of a tax. That's that part 2 right there. That information is located in 4012 publication at tab H-6. So if I have to draw out my part of my retirement and I don't meet an exception for drawing that out, then I'm going to pay a 10% tax. It's going to be a penalty, but it's going to show up as a tax. Not only am I paying taxes on the distribution itself, but I also pay that penalty of 10% in the form of a tax. When I say exceptions, those exceptions are shown on tab H-7. These are the exceptions to the penalty amount. If the taxpayer is not meeting one of those exceptions, then the taxpayer is going to be penalized there. Okay? So my question when the taxpayer brings in that Form 1099-R, and I see that there was a distribution there, and it was an early distribution, I'm going to be asking the taxpayer, what did you use the distribution for? If the taxpayer says I used the distribution to pay for some uh, medical expenses, then yeah, that's going to be one of the exceptions. If the taxpayer is using the distribution for higher education expenses, then yeah, that's going to be one of the exceptions. So just know that the exceptions are there as well. If you get hung up uh, with something like this in front of your clients or in front of the taxpayer, just holler at one of us and we'll be able to come over and help you out. But just know the exceptions are here. If the taxpayer is meeting the exception to the entire distribution or part of that distribution, the penalty and the exception is figured on one form, which is the form 5329. This is your additional tax on the early distribution. This is your definition right here. This would be your early distribution amount. Early distributions that are not subject to the additional tax. If that entire amount um, was not uh, meeting the exception, or let's just say if the amount on line 1, part of it meets the exception for line 2, that amount goes on line 2, and then the exception code is over here in this little area right here, and then the penalty is figured on whatever is left. For instance, if I got a distribution of $1,500 and I use $500 to cover some excess medical bills and stuff, then I would put 500 here, put the exception code here, so that 1,000 would be subject to the penalty. The 10% would be subject to a 10% penalty, which is $100 added to the tax on the tax return. We already spoke a little bit about the health savings account distribution. If those, if that distribution from the health savings account is not used for medical expenses, then that distribution becomes subject to a 20% tax. That again is a penalty. The exceptions are death, disabled, or being over age 65. Then we have one more. Our other taxes has to do with the repayment of the home first-time home buyers credit. Back in 2008, the IRS was giving taxpayers a big old sum of money for those people to purchase their first home. I think it was up to 75 or up to $8,000, 7,500 or $8,000 for the purchase of your first home. Now, the IRS just didn't give it to them. It was kind of like a loan. They were to pay it back interest free over a 15-year period, which is a 15-year equal installment with their yearly tax return. That began in 2010. It will end in 2025. So next year, if the taxpayer received that first-time home buyers credit back in 2008, 9, and 10, then they'll have it paid off by the end of 2005. So that $500 or $450 or whatever it is that they're paying with their yearly tax return, it should be paid off in the year 2025. So I know they'll be happy about that. Okay, now if that home ceased to be the taxpayer's main home before the 15-year period was up, the taxpayer was required to repay all the annual installments in the year that they disposed of that principal residence. Once again, this is our Schedule 2, our other taxes line. which is our self-employment tax, our Social Security tax on unreported tips, our additional tax on IRA distribution that did not meet one of those waivers. Here's our repayment of our first-time home buyers credit. All of that is in our other taxes section, part 2, and then we can drop down here to other taxes continue. Here's our HSA distributions, that 20%. All of that gets added as additional tax. So once again, this is the back of our 1040. These are our other taxes on line 23. So then line 22, if there's anything there, the tax that is left over after we applied all of these non-refundable credits, that gets added together. Now we're down to our total tax amount. All right. So we're just about there. We have one more section to cover. Welcome back, everybody. I believe this is going to be our last agenda item. So we're still on Form 1040, page 2, and now we're down to the payments and refundable credits section. So we've covered all of this from above line 25. And now we're down to this section right here, our payments, refunds, and amounts owed. So number one, our line 25A is our income tax that's been withheld from our W-2s that automatically gets populated on line 25A, 25B. Those are 1099s that have withholding on it or in them. And then we will jump down here to line 26, our estimated tax payments and amounts paid from, this says 2022, but that should be 2023 return. So let's see what's next. The federal income tax system is a pay-as-you-go system. That means taxes are paid as income is earned or received during the year and is referred to as withholding credits. So that shows up on the Form W-2, most of our 1099s and 1099Gs, etc. Many taxpayers have income from self-employment, dividends, interest, capital gains, rents, and royalties. The same pay-as-you-go system applies to this income as well. If the tax due on these types of incomes exceeds certain limits, estimated tax must be paid quarterly by the taxpayer. If the estimated tax payments are not paid when they're required, a penalty could be imposed. Additionally, taxpayers who overpay their income taxes in one year can apply all or part of their overpayment to next year's estimated tax by indicating the amount that they want to pay. So this paragraph here tells me if the taxpayer is self-employed or they have high interest dividends or capital gains investment type property that they're going to be taxed on and it reaches certain limits, those taxpayers are required to pay their expected income or estimated income tax quarterly. That means every 3 to 4 months, the taxpayer is sending in a payment with the voucher to the IRS to help cover their taxes at the end of the year. This table represents a summary of the Earned Income Credit eligibility requirements. This is another pretty large refund for our clients as well. So the table itself is located in the publication 4012, tab I, page 4. So you can see that there are 4 columns here. Part A, first column, are the rules for everyone. In order for the earned income credit to be available, there are requirements. Part A, for everybody. Taxpayers and qualifying children must all have Social Security numbers that is valid for employment by the due date of the return, including extensions. You must meet certain requirements if you are separated, so I don't care about that. They must be United States citizen or a resident alien all year. So those are the biggies for the earned income credit for our clients. Investment income must be 11,600 or less, and they can't be a qualifying child of another taxpayer. Here's your column B. These are the rules if you have a qualifying child. The child must meet the relationship, the age, the residency test, and the joint return test, but not necessarily support test. The child doesn't have to be your dependent. The qualifying child can't be used by more than one taxpayer to claim the earned income credit, and the taxpayer cannot be a qualifying child of another. Part C, rules if you don't have a qualifying child. You must be at least age 25, but under age 65 as of December the 31st. You can't be a dependent of another person. You must live in the United States for more than half of the year, and you can't be a qualifying child of another person. Part D has the earned income and the AGI limitations, or the adjusted gross limitations. Here, your earned income and AGI must be less than 59, 59,899 or 66,819 if married, filing joint with 3 or more qualifying children. A different AGI amount with 2 or more children, a different amount with 1 qualifying child, and a different amount if there are no qualifying children. If the taxpayer's Social Security card says valid for work only with INS or DHS authorization, the taxpayer can use the Social Security number to claim the EIC, or the Earned Income Credit, if they otherwise qualify. If the taxpayer's Social Security card has a not valid for employment imprint, and if the cardholder obtained the Social Security number to get a federally funded benefit such as Medicaid, they can't get the earned income credit. Okay, so all of these little notes in here, you might want to read up on them. But once again, TaxSlayer will figure out all of that based upon what has already been input into the program. We talked about the child tax credit uh, that is used to reduce the tax liability. This is the other part of that child tax credit. It's called the additional child tax credit. As the information indicates, the child tax credit is generally a non-refundable credit. However, certain taxpayers may be entitled to a refundable additional child tax credit. Taxpayers with more than $2,500 of taxable earned income may be eligible for the additional child tax credit if they have at least one qualifying child. Taxpayers with 3 or more children may also be eligible for additional child tax credit regardless of their income. Now, this additional child tax credit is limited to $1,700 per qualifying child. And once again, TaxSlayer figures that out for us. We've already talked about this Schedule 3, the net premium tax credit from the marketplace. So that information drops down into the payment section and then adds to the refund amount. So we'll just say right here, taxpayers can get an automatic 6-month extension of time to file by submitting the Form 4868 application for automatic extension. Now, this form extends the time to file the tax return until April the 15th. This is only for an extension of time to file, not an extension of time to pay. If the taxpayer expects that they are going to have a balance due in October the 15th or on October the 15th, when they do finally file that tax return, they should pay the amount that's due with the extension. If they do not, and they end up owing a tax when they file on October the 15th, the penalties and the interest will revert back to the last day of tax filing, which is April the 15th, and not October the 15th. So, yay, y'all, we have done all of this, all of that. So, these are all of our payments that's been accounted for. And so now we're down to line 34. If line 33 is more than 24, that is the tax, subtract 4 from line 33, and this is the amount of the overpayment. That is your refund. Okay? Now, your refund can be delivered to you in paper format, that is uh, the taxpayer's uh, choice, or we can electronically file it for the taxpayer and direct deposit into the taxpayer's bank account. I say direct deposit. It's not we, it's the IRS that does the direct deposit into the taxpayer account. But in order for IRS to do that, we will have to have their routing number and their account number, and whether or not it needs to go into checking or into the savings account. Now, with this, the taxpayer can split that refund if they choose in up to three different accounts, but their names would have to be shown on those three different accounts, and they would have to have the routing number and the account number for those three different accounts. Now, am I going to take the taxpayer's word for those routing numbers and account numbers? Oh, honey, I've had this account number for 25 years. I know what the account number is. Yes, ma'am, I bet you do. However, I'm going to have to see something in writing, either your check. I can just look at the account, the routing number and the account number, or it'll have to be a statement from your bank, or it could be something that you've taken a picture of on your phone that has this information on it, or it could be from a prior year's tax return that you want to put the money in. So we have to see something in writing, because if the taxpayer gives us a wrong number and we put that in to TaxSlayer and that refund goes out, that refund is going to go to that routing and account number. And the taxpayer is going to come back to us. They're very upset. Okay, so enough said about that. Line 36 is the amount of line 34, your refund amount, that you want applied to, say, your 2025 estimated tax. We can put an amount here, okay? So just know that the taxpayer can take part of that refund and put it in over in for next year's account. They won't get any interest on it, but IRS will let it sit there. There's another little section here that talks about an amount owed. If the taxes are more than the payments amount, then that means that the taxpayer owes money. At this point, the taxpayer IRS can do a direct debit from their account, or the taxpayer can elect to mail in their payment to the IRS before April the 15th. If they mail it in after April the 15th, then it's very good possibility that there'll be assessed some penalties and interest there. All right, y'all, we have covered the. So now, you all, we are ready to enter into our practice lab. So this is what you've been waiting for. Let's get some practice in. The practice lab for tax layer input on one of the scenarios. Okay, so here are some instructions for the practice lab. You want to go back to Vita Central where you took the ethics and the intake certifications, where you got your original certifications. Go back to Vita Central. Okay, when you get to Vita Central, I want you to scroll down to the quick links, and there is a quick link for practice lab. So go there now. When you get to the practice lab, a little screen like this is going to show up. It's going to greet you, welcome you to the practice lab. Your password is Train Pro Web in all caps. Train, TrainProWeb, Train Pro Web. That is going to be the password to the practice lab. Now, since you have never been to the practice lab before, you are going to have to create an account. You've been into Vita Central, but you have not been into practice lab. So you are going to have to create a new account. Your password, you'll use your username, whatever it is you want to use. Your password, it needs to be 15 characters long. So write it down, 15 characters long. Your program type is going to be Vita, and your SIDN you need to leave blank. So we in class are starting to work on exercise 8 or scenario number 8, I should say, in excuse me, in the booklet or form book 6744. That is your blue and white book, test retest test book. In the paper book, the page number is 92, and if you're looking at it online, that page number is 98. If you don't, if you're listening to this from our YouTube, you want to go to Google and do irs.gov, okay, and search form 6744, which is your test retest book, and then go to the advanced section of the book or to page 98, which is where the scenario for Stephanie Winter is located. Just so you know, these are real test retest questions that is in this book. These questions will show up in the online testing for the advanced test. We are not taking the basic test. We are only taking the advanced test. That's it. Oh, okay, so actually the advanced test scenario number 1 begins on page 75. Scenario number 1 is for Sharon Smith. You don't have to do any inputs at all. So just know scenarios 1 through 9 are real test questions for your online test for the advanced certification. We are doing in class scenario number 8, which is Stephanie Winter. Stephanie Winter's information begins on page 98 of the online publication and page 92 for the paper. If I were to go there and look at scenario number 8 for Stephanie, it gives me my interviewing notes. Using the software, complete the tax return, including the 1040 and all appropriate form schedules or worksheets, and then answer the questions following the scenarios. Whenever you see a social security number or an employer's identification number, replace the X's with any 4 digits of your choice. Our interviewing notes is Stephanie is a paralegal. She's 26 and single. She has investment income, broker's consolidated statement. Let me go over here real quick for you. There's her consolidated statement that is on page 101 in the paper format. It has 2024 tax reporting statement, XYZ investments. So that's her consolidated statement on page 101 as well as 102. So keep that in mind. You might want to jot that down somewhere. Stephanie is self-employed. She delivers meals for Fast Eats on the weekend. She's got a 1099 NEC, which is not employee compensation, and a Form 1099-K that is from the delivery business. She also received additional cash payments of $570 in tips. Is that $500, $570 in tips income? It certainly is. Yes. Stephanie's uses the cash method of accounting. Her business code is listed 492000. She has a statement from Fast Eats indicating the fees paid for the year. These fees are considered ordinary and necessary for food delivery business. So that is the 150, the 50, and the 600. Those are ordinary and necessary for the food delivery business. Stephanie also kept receipts for the following out of pocket expenses. She's got $80 for tolls while making deliveries, which is her business. That sounds ordinary and necessary to me. $300 for a speeding ticket, not. And then she's got $160 for her lunch. That is not an ordinary and necessary expense. That would be if she were entertaining prospective clients or something like that. But she's just having lunch just like you and me. So those last two, I don't think would be, in my opinion now. You make up your own mind, but those two are not ordinary and necessary expenses. Stephanie's record keeping application shows that she has driven 3,000 miles during and between deliveries. She placed her only vehicle, SUV, in service March 15, 2020. Total mileage is there and all of that for her business miles. That's going to be computed on her self employment schedule. You'll see that once you get in it. Stephanie is paying off a student loan from 2019 when she completed her undergrad degree. She's working on her Jewish doctorate degree to start a new career as a lawyer. She took a few college courses this year at an accredited college. Stephanie also took an early distribution of $5,000 from her IRA. So Stephanie's 26, so we know that she's not age 59 and a half. So she is liable for a penalty for taking that distribution early. She used 2,400 of her IRA distribution to pay for education expenses for the current year. Is that an eligible waiver? She has never made any non-deductible contributions to her IRA. if she has a refund, she'd like it deposited into her checking account. So the next page shows Stephanie's Social Security card with the four X's. So you use four digits of your choice. The next few pages is her intake interview and quality review form that you'll need to review very, very carefully. Then she has her 1099-R, which is her distribution from her retirement plan. She's also got a W-2 that's included in here. She also has, turn the page, she also has a Form 1099 NEC and a 1099K from her delivery business. We've already talked about her investment, consolidated investment that shows Form 1099 DIV. There's an amount there, as well as her 1099 INT, which is her interest. And then at the bottom, it says the summary of her 2024 proceeds from broker and barter exchange transactions, the sales price uh, of stocks and bonds were 5,100. And it says this tax information is being furnished to IRS. If you are required to file, a negligence penalty or other sanction may be imposed if this income is taxable and IRS determines that it has not been reported. So if we turn the page, we show her stocks and bonds, her investments. We have a 1099B short term for which basis is reported to the IRS. There's your stock, which is Nebraska County Common Stock, the date it was acquired, the date it was sold. So all of this you're inputting into a tax layer. That next item is a 1099B. That is a long-term transaction for which basis is not reported to the IRS. What determines long-term and short-term? If I sell an investment under a year, which means that I held this investment, this stock, this bond for a year or less, that is short-term transaction. If I held it for over a year, that becomes a long-term transaction. Then I also see Stephanie's student loan interest statement as well as her tuition statement. And the next page is her bank or her check. So we can pick up her routing number as well as her account number. That first series, the 111000025, is her routing number. The next series of numbers are always the account number, and then that last series of number is typically a check number. And then you have the questions that you need to answer about Miss Stephanie Winters. What I always like to tell everyone before you go online to take any test, jot your answers down in the book first and then review it to make sure that you have answered the way that you want to. So that is the information for Miss Stephanie. That is the test. Now remember, this book is a test retest booklet. There is a retest for Miss Stephanie also, and that is going to be on page 124. You get two opportunities to take the test. If you take the test the first time and make 80%, you have passed the test. Okay? So you can't go back and say, oh, I could do better than this. The system is not going to let you to do that. 80% or better, you're good to go. So these are our checkpoints for our practice lab. Here is Miss Stephanie down here. These are checkpoints when you start to input the information into TaxSlayer. Checkpoints for scenario 7 and checkpoints for scenario 9. So you can take a picture of that or not. These are our study sessions. We do have a study session that is coming up January 23rd from 6 to 9. It will be virtual. You need to sign up for that inside Better Impact. And then another virtual study session from 1 to 4 on January the 27th. You can go to Better Impact to sign up for that as well. These are your primary contacts here. Your volunteer coordinator is Jonathan Hale. This is his email address. You have your volunteer training coordinator, Amber Brown, and this is our Dallas Community Tax Center's website here. Okay, my name is Gail, and it's been my pleasure. See you at the site, y'all.